This is still a pricing model. Because you look at what's the risk-free rate, what's the excess return, the process that I'm going through. And so this is a moderately pricey market with risks of interest rates more going up than down, okay, because we still have the certain set of conditions. And we have central banks who have lost a lot of money. Central banks themselves have lost a lot of money.
How do these losses affect you? Ray Dalio believes the financial world's ticking time bomb lies in something you might not even be aware of: central bank losses. In this video, we'll dive deep into the world of high finance and unravel the insights of one of the most influential voices in the industry. Ray Dalio's journey, warnings, and expertise are your window into the complex web of central banking and the compound effect it's creating. Stay with us to discover why understanding these losses is crucial for anyone concerned about the future of the global economy. Ray Dalio recently shared a thought-provoking perspective on the state of U.S. stocks. He's warning that American stocks are still quite pricey despite recent gains, and that's where your attention should be. Dalio sees a complex world with political and economic challenges brewing, and it's essential to understand why. The market is currently walking a tightrope with interest rates, and Dalio believes the risks are tilted towards rates going up, not down. This might seem like technical jargon, but it has real-world consequences. As interest rates rise, treasury yields increase, and this, in turn, means a larger risk-free return for investors. What's the catch? Well, it diminishes the excess return you might get from stocks. According to Dalio, central banks are facing significant losses, which could spell trouble, particularly if there's political bickering over the Federal Reserve's financial strategies. To make matters more complex, these losses don't just disappear. They have a compounding effect, which is essentially financial snowballing in the wrong direction. Think of it like this: losses incurred by central banks lead to a surge in debt, and that's not good news. The budget deficit grows, and interest expenses keep climbing due to higher rates, intensifying these losses. It's not just about the dollars and cents, it's about the economy's overall health. Dalio also has his eyes on the political drama in Washington. He's concerned about the internal tensions and the extreme partisanship that could create a treacherous path ahead. It's a reminder that the rules and norms we've counted on in politics are hanging by a thread. There's a prediction of a brewing political storm over the next year, which could throw more uncertainty into the mix. So, when you look at the bigger picture, economic and debt issues, and rising international tensions, especially with China, combine to create a challenging scenario. The seasoned investor's caution is understandable. Even with those rising interest rates, the S&P 500 is trading close to its all-time high. But this situation has cast a shadow on the allure of stocks compared to bonds.
Okay, the Fed is losing a lot of money and financing the deficits, and that becomes a political issue. That could matter to how this happens. But those kinds of losses then create a compounding effect in debt. When you have the losses, and you're producing losses, and you have a negative income because of where interest rates are, where short rates are, where long rates are, how they own long rates, and they have to pay out short rates.
Ray Dalio and Nobel laureate Paul Krugman share the same concern about the growing U.S. budget deficit, but they see limited options to tackle this looming problem. While both experts acknowledge the need for a lower deficit, the paths to achieve it appear challenging in today's political landscape. The two primary routes to control the deficit are cutting spending on social programs or raising taxes. However, with a split Congress and political divisions, neither option seems likely to gain significant traction. In his recent New York Times op-ed, Krugman expressed his doubts about the practicality of either approach. Krugman highlighted the increasing cost of borrowing as interest rates rise. Although this doesn't pose an immediate risk of a fiscal crisis, it does imply higher costs to service the mounting U.S. debt, which surpassed $33 trillion for the first time this year. According to Goldman Sachs strategists, servicing the debt already consumed around 2% of the national GDP in 2022, potentially doubling to 4% by 2030. The Federal Reserve's reluctance to lower interest rates further complicates the situation, as officials are focused on managing inflation. Markets are already pricing in a high probability that rates will remain at their current level or rise further by June of the following year. To narrow the deficit gap, the government could reduce spending on welfare programs such as Social Security or consider tax increases. Krugman sees tax hikes as the more practical solution, given that U.S. taxes account for a smaller percentage of GDP than other countries. However, implementing substantial tax increases seems unlikely, with Republicans controlling the House of Representatives. Policymakers have been locked in debates over spending issues for months, with the government narrowly avoiding a shutdown in September. Krugman pointed out the challenge of reaching a political consensus on tax increases, especially those impacting the wealthy, as conservatives often prioritize tax cuts. Despite public sentiment favoring increased taxes for the rich, a clear political path to meaningful tax hikes remains elusive. The budget for the fiscal year remains unresolved, and Congress faces a deadline of November 17th to finalize the next funding package. Finding a viable solution becomes an increasingly pressing concern as the deficit grows. But before we continue, we want to thank you for watching this far. Speaking of Congress, the surprising removal of Kevin McCarthy from the U.S. House Speaker's position caused some concerns in the financial world. This move, triggered by a group of hard-right Republican lawmakers, came right after McCarthy had managed to prevent a government shutdown by working with Democrats on a deal. For some, this political turmoil is seen as part of a broader pattern of dysfunction in Washington, although it's not expected to directly destabilize the markets. The 30-year Treasury bond yield reached its highest point in years, and long-term Treasury yields surged. Despite this upheaval, the markets remained somewhat focused on economic data, such as a robust U.S. jobs report. Stocks initially dipped but managed to recover. Investors are now keeping an eye on inflation data and trying to gauge the Federal Reserve's potential interest rate moves. Additionally, the surprise attack by Hamas on Israel caused oil prices to rise and a slight uptick in haven-related assets like the U.S. dollar and gold. The removal of McCarthy without a clear successor and the looming threat of a government shutdown contribute to the uncertainty surrounding U.S. governance, particularly when market volatility, especially interest rate volatility, is on the rise. This situation follows the recent debt ceiling showdown, which saw the U.S. narrowly avoiding its first-ever default and led to a credit rating downgrade by Fitch Ratings. While some analysts view these events as indicators of increasing political polarization, others believe it's not a new problem but rather a long-standing issue. The U.S. is still a long way from resembling emerging market nations in terms of governance risk. However, political dysfunction does add an element of uncertainty to economic data, making market fluctuations more extreme and volatile. This correlation between governance risk and the yield on long-term Treasury bonds is evident over time. The United States isn't the only developed market grappling with increased dysfunction. The UK experienced its own bond market sell-off, creating parallels with emerging markets as government actions prompted investors to question and challenge policy changes. While the US isn't quite in the same category as emerging markets, a sell-off in long-term US debt tied to concerns about rising debt and political dysfunction is certainly noteworthy. So, as what Ray Dalio highlighted becomes more apparent, it's crucial for you to stay in the know about the financial markets and keep a close eye on central bank actions. The world of investments is a dynamic one, and economic and geopolitical risks play a pivotal role in shaping your financial future. Remember, being informed isn't just about protecting your assets, it's about seizing opportunities and making wise decisions. So, will you stay on the sidelines, or will you actively engage with the ever-evolving financial landscape? Let us know in the comments section below, and while you're at it, make sure to smash the like and subscribe buttons down below. Additionally, I highly recommend watching this fantastic video if you want to know more about Ray Dalio's insights into the economy. Just click this video right here. Thank you for tuning in, and stay tuned for more exciting content in the future.